Okay guys, welcome to another video of audit. Now we're going to be continuing chapter 3. Chapter 3 is divided into 4 parts. Okay, the first one related to audit risk and risk assessment, and now we're standing here at internal control. Okay, fairly small chapter, fairly easy chapter. It has a few difficult points or a few lengthy points, but other than that I think it should be all right. Okay, the remaining two are we'll discuss it in the next video, but this is only for the internal control. Okay, so what are we going to cover in this video? Firstly, we're going to cover the basics, which is the meaning and benefits and limitations. Okay, so here limitations has been asked multiple times, so I would ask you to focus here more. Okay, and next is the components of internal control. Okay, so there are basically 5 components. Okay, and that also has been asked quite a few number of times. Okay, next we're going to be seeing relevant controls and irrelevant controls. What are relevant for the purpose of our audit, what are irrelevant for the purpose of our audit. Okay, and then we're going to see how we're going to review and evaluate our internal controls, and lastly we're going to see the methods of evaluation. This 10 points is that there are 10 sub points that we'll have to remember. Okay, just to give you an idea of what we're going to see. Okay, next, without any wasting of time, let's just jump into the meaning. Okay, first I'm just going to give you this I'm just going to explain through this flowchart, and then we're going to jump into the material. Okay, this material is from Edu 91. Okay, next, let's just jump into the meaning of internal control. Okay, what is internal control? Internal control is basically a process that is designed, implemented, and maintained. Right? Let me just fill in these things here. Okay, it is a process that is designed, implemented, and maintained by those charged with governance or the management or any other personnel. Okay, so basically this entity, before somebody else comes and checks whether uh, the accounts, the records are intact with the accounts that is prepared, or whether if it is whether though these accounts are prepared as per our AFRF, which is applicable financial reporting framework, right? Before somebody else checks it, first there's going to be an internal checking. Okay, so this internal checking is part of the internal control. Okay, so it is a process that is designed, implemented, and maintained by those charged with governance or management or any other personnel. Now, this is like this definition is divided into two parts. Okay, so firstly it just gives you that it is a process that is designed, maintained, implemented by those charged with governance or management or any other personnel. The second part of the definition talks about why this process is created. Okay, or what it aims to do. Okay, so internal control is created to provide reasonable assurance about the achievement of an entity's objectives with regard to, firstly, reliability of financial reporting or financial reports. Okay, next, the efficiency and effectiveness of operations and safeguarding of assets. And lastly, compliance with law and regulation. Okay, so we just come from the top again. Okay, right. So internal control is a process that is designed, implemented, and maintained by those charged governance or management or any other personnel to provide reasonable assurance about the achievement of an entity's objective with regard to reliability of financial reports, efficiency and effectiveness of operations, safeguarding of assets, and compliance with law and regulation. So I'm sure if you guys have seen from the beginning in the first video that discusses the basics, I've already covered this, right? So we've not yet jumped to this chapter yet. Okay, so this is for the people who just jumped into this particular chapter, right? Let's. So here what we do is we just tell it 2-3 times so it sticks in our brain, right? Internal control is the process that is designed, implemented, and maintained by those charged with governance, management, or any other personnel. Why is this done? This is done to provide reasonable assurance about the achievement of an entity's objectives with regard to reliability of financial reports, efficiency and effectiveness of operations, safeguarding of assets, and compliance with law and regulation. Okay, let's just tell it one more time. Okay, and then we'll move on to benefits and limitations. Okay, so firstly, internal control is the process that is designed, implemented, and maintained by those charged with governance. If this is a bit distracting, I'll just remove this. Okay, let's just come back again. Okay, one last time before we jump to benefits and limitations. Okay, internal control is a process that is designed, implemented, and maintained by those charged with governance, management, or any other personnel. Okay, why is this created? To provide reasonable assurance as to the achievement of an entity's objectives with regard to reliability of financial reports, efficiency and effectiveness of operations, safeguarding of assets, and compliance with law and regulation. Okay, now I'll just remove everything that I've written and we'll just try to fill in the blanks ourselves. Okay. Okay, so internal control is the process that is designed, implemented, and maintained by those charged with governance, management, or any other personnel to provide reasonable assurance about the achievement of an entity's objectives with regard to reliability of financial reports, efficiency and effectiveness of operations, safeguarding of assets, and compliance with law and regulation. Okay, so now that this is done, we just move on to the benefits and limitations. Okay, we'll just read through this also for good measure. Okay, as per SA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment, the internal control may be defined as the process designed, implemented, and maintained by those charged with governance, management, and other personnel. Okay, to provide reasonable assurance about the achievement of an entity's objective with regard to reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets, and compliance with laws and regulations. Okay, now here the term control refers to any aspect of one or more components of the internal control. Like I told you, components of internal control we'll just discuss below. Okay, we'll just discuss later in the video. Okay, next moving on to benefits. There are only 3 benefits over here, fairly easy to remember. Okay. IP, IR, and DFAB. Okay, so IP is identifying potential misstatements. Okay, P for potential misstatements. Okay, R for risk of material misstatement. Okay, so firstly identifying potential misstatements. Okay, first here you're going to be either the benefits of understanding and internal control. Okay, we are going to learn understanding the benefits of internal control. Fairly easy. There are only 3 points here, right? Firstly, it is identifying potential misstatements. Okay, we're going to be identifying potential misstatements. Next, we're going to be identifying factors that affect the risk of material misstatement. And lastly, designing the nature, timing, and extent of further audit procedures. Okay, like I said, firstly is IP, IR, and DFAB. Okay, FAP is further audit procedures. Designing, right? Firstly, it is identifying potential misstatements. Okay, potential misstatements. Next, R is R for risk, right? Identifying factors affecting, identifying factors affecting risk of material misstatement. Okay, next, this is designing nature, timing, and extent extent of further audit procedures. Okay, now I'll just give you a brief explanation. Okay, so if an auditor, or if you understand how the internal control works, you can find out where they might have made mistakes. That is potential misstatement. Okay, and when you find out where they've made mistakes, you can also get to know how frequent those mistakes are, or how much materiality those mistakes have, whether it is a small mistake or a big mistake, right? If it is in the nature of bigger mistakes, then you'll increase the risk of material misstatement, so obviously the ROMA will go up, right? So understanding the internal control is very important. Okay, lastly, designing the nature, timing, and extent of further audit procedures. Okay, so now once you've understood that, oh, they might have made mistakes here, okay, oh, okay, and these are big mistakes, then you will have to increase your further audit procedures, meaning you will have to apply more procedures to get more evidence of satisfaction, right? before you are before you are satisfied that this company's accounts is properly made, right? So what are the things? Firstly, you will go there and you'll see where the mistakes are made, right? So you can find out where other mistakes might have been made, so that is potential misstatements. Secondly, once you find out the mistakes, you will see how material they are and how they affect your risk of material misstatement, right? So firstly, you will identify potential mistakes, and then you will find out how much effect it has on your risk of material misstatement. And lastly, after adding those two, after finding out how many mistakes there are and how material it is, you'll also change the nature, timing, and extent of your further audit procedures. Okay, next part is the limitations. Okay, this point is, I feel like it's a bit retarded, to be honest. Okay, it just says that uh, the inherent limitation is that it can provide only reasonable assurance and not absolute assurance. Okay, and that it just says that the ICE internal control system gives only reasonable assurance but not absolute assurance that its objectives are achieved, which I feel like even if you don't read it, it's okay. Okay, next, coming to the actual limitations of internal control. Okay, this is quite important. Okay, very important topic. Okay, so the request you to, in case you're playing some Subway Surfer or some brain rot things, like how I used to do, I'd suggest you to keep that aside, right? Firstly, let's just ignore whatever I've written here and just focus on these points. Okay, here the limitations are, firstly, we'll just go by the headings first and then we'll jump into what they actually are. Okay, firstly, internal control can only provide reasonable assurance. We know that, yes, we know. Even audit also provides only reasonable assurance. Okay, no matter how good of an auditor you are, you can only provide reasonable assurance, right? Second is, there is human judgment in decision making. Why is there a limitation of internal control? Why internal control cannot be completely effective? Firstly, it can provide only reasonable assurance. Isn't that what we're trying to prove here, right? We're trying to prove that internal control can provide only reasonable assurance, and the first point that they've put is internal control can provide only reasonable assurance. It's pretty bad. It's pretty stupid. I mean, it's not their fault. It's the person who wrote this answer, right? It's not Edu91. It's probably ICI. Right? Internal control can provide only reasonable assurance. That's the first point. And the second point is of why there is a limitation in internal control is because human judgment is involved in the decision making process. Okay, next we're just reading the headings and then we'll jump into the paragraphs. Okay, lack of understanding the purpose. Okay, so the person who has this data or who is performing these controls, he doesn't know why it is being done, right? Suppose he sees a transaction, like suppose the materiality is set at 1 lakh, and suppose he sees a transaction of rupees 1 lakh, right? But then he doesn't know why that particular materiality is set at 1 lakh for that particular transaction, and he just doesn't report it, right? Thinking that it is a normal transaction and just lets it through. So here, lack of understanding is also a limitation in internal control. Next, collusion among people. Okay, suppose an entry requires two-factor authorization, meaning one person over here also has to authorize, another person here has to authorize. Okay, so since two people have to authorize, right? If these two are working together, right? If these two are working together, then this is called collusion. Okay, meaning they are working together, right? So if this process is circumvented, or if there is collusion uh, that exists, then obviously that internal control is waste, right? It is complete garbage because it is not going to be effective at all, right? So this is another it is another limitation of internal control. Next, judgments by management. Okay, so there are a lot of obviously this point and this point go hand in hand, right? There's human judgment in decision making, right? And there are judgments by management, okay, in designing and implementing the controls. Okay, so in designing, the management may think that a particular kind of transaction is not material, right? But how much does the management actually know, right? So there might be a limitation when it comes to the management knowledge or the experience, right? The places where they might think is immaterial might actually end up being material, right? So judgments by management also comes there. Okay, next, limitation by in case of small entities. Okay, so in smaller entities, it just says that there okay, since there's only going to be like one employer, right? Who's the owner, right? Employer slash owner. Just set it up. And one employer or the owner, right? And he probably has 3 or 4 employees that he can very easily oversee, right? Or maybe not even 4, maybe 2 employees he can easily oversee, right? And there's not going to be much distribution or segregation of duties, right? Because of which he can exercise even more control. I don't know why they've added it into limitation, but still they've just added this point, and we're going to have to write it in the exam if it comes. Okay, now we'll just start from the top again. Okay, firstly, the first limitation of internal control is that it can give only reasonable assurance. Okay, first limitation of internal control is that it can give only reasonable assurance and not absolute assurance. Okay, let's just dive into what it is saying. Okay, internal control, no matter how effective, can provide an entity with only reasonable assurance about achieving the entity's financial reporting objectives. The likelihood of their achievement is affected by inherent limitations. Okay, it is very stupid, right? So inherent limitation is blaming that one of the limitations of internal control is reasonable assurance, right? But reasonable assurance is blaming it back on inherent limitations, so it's kind of a loop, right? But we still have to remember, right? So if you want to make it make sense, just remember that internal control, no matter how effective, can provide an entity with only reasonable assurance about achieving its financial reporting objectives. That's all. Okay, the remaining part you can just ignore. Okay, so the first point of limitations of internal control is that internal control can provide only reasonable assurance. Okay. Next point is that human judgment is involved. Okay, just go through that also. Reality is that human judgment in decision making can be faulty, and that breakdowns in internal control can occur because of human error. Okay, that's pretty obvious, right? There might be human error that is involved. Fairly reasonable, right? This point. First point was that there is only reasonable assurance. Second point, that human judgment is involved. Third point is lack of understanding the purpose. Okay. The third point is lack of understanding the purpose. Right. The operation of a control may not be effective. Right. The operation of a control may not be effective, such as where information produced for the purpose of internal control is not effectively used because of the individual responsible for reviewing the information does not understand its purpose and fails to take appropriate action. Okay. So basically, the operation of a control will not be effective if the information produced is not effectively used because the individual responsible for reviewing the information doesn't know its purpose and fails to take appropriate action. Okay, fairly simple, right? If the person doesn't know the significance of why that control is placed and why he has to operate that control, or meaning why he has to keep an eye there, right? If he does not understand the purpose, then he probably is not going to think that anything is suspicious, right? Next, so the first point is the limitations of internal control. The first point is it provides only reasonable assurance. The second point is that human judgment is involved. Third, that in case there is a lack of understanding, the operations of control won't work properly. Okay. Next, now we're coming to the fourth point, which is collusion among people. Okay. So here, controls can be circumvented by the collusion of two or more people or inappropriate management override of control. Okay. Management, for example, management may enter into side agreements with customers and alter the terms and conditions of the entity's standard sales contract, which may result in improper revenue recognition. Also, edit checks in the software programs are designed to identify and report transactions that exceed specified limits that may be overridden or disabled. Okay, meaning suppose in the software that says for every 1 lakh rupees worth of transaction, if there's any 1 lakh or more, okay, if the transaction value is more than 1 lakh, then the salesperson has to get authorization from manager. Okay, and now this manager who has the access to control these transactions, right, he can approve these transactions, right? So if the manager along with this salesperson colludes with any outsider, right, he can enter this without anybody else getting to know. Okay, he can ensure that this system does not trigger this particular transaction. Okay, because if he has access to whatever this software does, then he can circumvent that, right? So then there will be no control, right? It is as good as not having any control at all, right? So there might be collusion among people, so therefore controls may not be operative. Okay, next, just recap from the beginning. The first one was we're revising limitations of internal control. The first point is it provides only reasonable assurance. The second point was that it involves human judgment. Third point is that there is lack of understanding, and fourth point is that there might be collusion among people. Okay, next, fourth point. Okay. In designing and implementing controls, management may make judgments on the nature and extent of the controls it chooses to implement and the nature and extent of the risks it chooses to assume. Okay, so the extent of control and the nature and extent of risk it chooses to assume. Okay, so firstly, nature and extent of control and the nature and extent of the risk, right? So it might think that a particular place may not require that much control, so they might have not placed. Okay, they might have thought it is not that material, but in reality it could be material, right? So those kind of judgments by management could lead to limitations in the internal control. And lastly, limitations in case of small entities, right? Smaller entities have fewer employees, due to which segregation of duty is not practicable. Meaning, in bigger entities, one of the methods of internal control is segregation of duty. So there's no one place where power is consolidated, right? So when power is consolidated, there's a lot of complacency, there's a lot of uh, authoritarian kind of management behavior, right? So in that case, segregation of duties are done. Okay, but in smaller entities, this segregation of duty is not possible because there's only a few employees, right? In small owner managed entity, the owner manager may be able to exercise more effective oversight in a oversight than a larger entity. Okay? This oversight may compensate for the generally more limited. Okay, so basically this is not a limitation; it is like an exception to the limitation, right? Meaning these the above mentioned limitations won't work for smaller entities. Okay, so these limitations are compensated by the smaller nature. Okay, let's just go through it from the top again. Okay, so the first point was that first point of, let me just we'll just write it down. Okay, so we were discussing limitations of internal control, right? Internal control. Okay, so the first point was that due to the internal control, you can provide only reasonable assurance, right? uh, the sub points were that no matter how effective it is, it can only provide reasonable assurance but not absolute assurance, right? That was the inner point that you can write. And the second point was that human judgments are involved. Okay, rather human judgments. Okay, so in the in operations of certain controls, uh, human judgments may be involved. Oops, human judgments may be involved that could lead to human error. Okay, so this is the second point, right? The, okay, next third point was that there is that there could be lack of understanding, right? Lack of understanding, right? In this, what we had seen was that uh, operation of controls may be affected, or rather are affected when uh, basically I'm not writing the exact same thing, right? I'm writing whatever is acceptable, right? Operation of controls are affected when the individual uh, having the information uh, just excuse me 1 second. Yes. So here what we had learned was that the operation of control is affected when uh, the individual responsible for reviewing the information does not understand its significance and does not report such uh, rather such deviation, right? Deviation, right? This is see what it had given, right? Or rather fails to take appropriate action. You can just write that. Okay, does not take appropriate action, doesn't take appropriate action, right? Next, the fourth point was that there may be collusion among people. In this we had seen that controls can be circumvented if two or more persons work together to either disable or override the operation of control, or override the operations of control, or rather the control system, control processes, control systems, right? Control processes. Okay, controls can be circumvented if two or more people or two or more persons work together to either disable or override the operations of the control processes. Okay, we'll just see what is given there and then we'll try to make our answer as similar to that. Okay, so here we can see that there is collusion of two or more people. So here in this point there should be two or more people that are involved. Okay, two or more people, or inappropriate management overrides the internal control. Okay, fairly simple, right? Next, you don't have to give an example, right? That was just for understanding, right? Next, fifth point was that there are management decisions or management judgments or management decisions. Okay, so here there are two parts, right? So the first part was nature and extent of the controls, right? The control nature and extent of controls exercised, and nature and extent of risk that is assumed. Okay, so there are two parts, nature and extent of, okay, So we can basically write that management decisions affect the nature and extent of controls exercised and the nature and extent of risks that are assumed. Okay, so fairly simple, right? And lastly, last point was relating to the smaller entities, right? The smaller entities. Now here, what did we see about the smaller entities? First, we saw that um, segregation of duties is not possible, right? Segregation of duties is not possible, is not possible. Okay, secondly, due to the close overseeing, okay, close oversight rather, close over, no, that is wrong. Due to the rather employer or owner of small entity can exercise or rather can oversee the employees better than larger entities, better than larger entities. Okay, so for the first point was that segregation duties is not possible because it's a small entity, and the second point is that the owner or employer of the small entity can exercise or can oversee better than the larger entities. Okay, and the last point was that uh, the limitations, or rather smaller entities can overcome limitations of control due to close supervision. Okay, now we'll just go see what was given in the material and try to make our answer as close as possible. Okay, so here, smaller entities often have fewer employees, due to which segregation of duty is not practical. Okay, it is the same, not practicable, not possible. Okay, similar, right? Next, however, in small owner managed entities, the owner manager may be able to exercise more effective oversight than in a larger entity. Okay, so that's a more effective oversight, or that's all. The same thing, almost same thing we've written, right? The oversight may compensate for the generally more limited opportunities for segregation of duties. Okay, it compensates for here we have written limitation of control. It can compensate for, it's not overcome. So smaller entities can compensate limitations of segregation of duties due to close supervision. Okay, I'll just go through this only fairly quickly. Okay, the first point was that internal control can provide only reasonable assurance, right? And it cannot provide absolute assurance, right? And second one is relating to human judgment. Okay, firstly, it is reasonable assurance, human judgment, right? Next, the in operations of certain controls, human judgments may be involved, and that could lead to human error. Okay, fairly simple point. Next point is lack of understanding. Operation of control is affected when the individual responsible for reviewing the information doesn't understand the significance and doesn't take appropriate actions. Okay, he doesn't understand why that particular control is there, so he will not take any action. Okay, fourth point is collusion among people. Control can be circumvented if two or more people. This is one of the keywords. Okay, so collusion cannot be done by only one person. Collusion means coming together and doing something. Okay, doing something together. That is collusion, right? Controls can be circumvented if two or more persons work together to either disable or override the operations of control process. Okay, next, the fifth point is the management decisions, right? The management decisions with regard to 2 points of that: nature and extent of the controls that are exercised, and nature and extent of the risk that are assumed. Okay, fairly simple points, right? Last point is basically about smaller entities. Okay, due to the lesser number of employees, segregation of duties is not practicable or not possible, right? So the employer or owner, but the employer or owner can oversee the employees more effectively than in large organizations, right? And lastly, in smaller entities, here the smaller entities can compensate for the limitation of segregation of duty due to close supervision. Okay, fairly simple, right? Now just as a safety measure, I'm just going to write down all the headings, okay, so that at least the headings are stuck in the brain. Okay, so the first point was reasonable assurance, right? So just try to close your eyes and try to remember the points. Okay, the first point was reasonable assurance. The second point was human judgments are involved. Third point is that there could be lack of understanding, right? Fourth point is that there may be collusion among people. Fifth point, controls may include management decisions. And sixth point, last point, was about the smaller entities. Okay, let's just revise the headings once more. The first one was that internal control provides only a reasonable assurance. Second point was that internal controls involve human judgment and there could be human errors, right? Third point is that there could be a lack of understanding. Fourth point is that there could be collusion among people. Next, management decisions are involved. And lastly, due to the smaller entities. Okay, next moving on to just do a small recap from the beginning. What do you say? We started from here. Okay, what is internal control? Internal control is the process that is designed, implemented, and maintained by those charged governance, management, and other personnel. Why? To provide reasonable assurance about the achievement of an entity's objectives with regard to reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets, and lastly, compliance with law and regulation. Right? Fairly simple. Next, we moved on to benefits. The benefits are, there are only 3 benefits that we have to remember. The first one is IPES, identifying potential mistakes. Right? Identifying potential mistakes. IR is identifying factors affecting risk of material misstatement. Right? Identifying factors affecting the risk of material misstatement. And lastly, it is designing nature, timing, and extent of further audit procedures. First, I'm going to see, this is where he has made mistakes. And then I'm going to see where and all he could have made mistakes, meaning potential mistakes. And then after I find out that these are the places where he might have made mistakes, I'll see whether those mistakes are material or not, whether they affect my risk of material misstatement, right? So I'm just going to see whether they affect my risk of material misstatement. Okay, if they affect my risk of material misstatement, then I'm going to change my further audit procedures, right? Very simple. Identifying potential mistakes, identifying factors affecting risk of material misstatement, and lastly, it is designing the nature, timing, and extent of further audit procedures. Fairly simple. So these are the benefits. So understanding the internal control helps you to identify potential misstatement, identify factors that are affecting risk of material misstatement, and lastly, it helps you to design the nature, timing, and extent of further audit procedures. And when it comes to limitations, the limitations that we had just studied here, right? The first part was it provides only reasonable assurance, right? Reasonable assurance. Second point is that human judgment is involved. And the third point was lack of understanding, right? Lack of understanding. Fourth point is that there could be collusion among people. Okay, here there is a special point that it required two or more people. Okay, next, management decisions. Here there are 2 points. One is nature and extent of controls exercised, and second one was nature and extent of risks that were assumed. Okay, risks that were assumed. Next, in case of smaller entities, we found out that due to lesser number of employees, segregation of duties is not possible. The employer can uh, employer oversees the employees more effectively than in larger organizations. And lastly, the limitations of segregation of duty is overcome by such strict supervision. Okay guys, so these remaining 4 topics are pretty mentally exhaustive, right? So I'm just going to do that in a separate video, right? uh, it's going to be a fresh start, so give you like break, kind of a take a break, and then join back for these components of IC, relevant controls. I feel like it's a bit more in depth, right? So for this video, it's just going to be the basics, meaning, benefits, and limitations, right? I think it's sufficient for this one part, because the next part is pretty mentally exhausting, right? So I just don't want to club this in the same video. Okay. Okay. All the best, and I'll see you in the next video.